If you're struggling to understand why price sweeps highs and lows, triggers stop losses, and suddenly reverses direction, then you are missing one of the most important concepts behind smart money trading: inducement and liquidity. In this video, you will learn how professional traders use liquidity, market structure, and price action trading strategies to identify inducement zones, avoid fake breakouts, and understand how price really moves inside the market. We will break down real chart examples, liquidity sweeps, support and resistance traps, and the core principles behind modern smart money concepts and market mechanics. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Before we continue, I want you to pay close attention to what David Paul is about to explain, because this directly connects to everything we are discussing in today's video about inducement, liquidity, and why so many traders repeatedly get trapped in the market.
Institutional traders are taught from their first day that they buy good levels or they don't buy at all. Unfortunately, most retail traders will wait for some confirmation before they get in. That could be a candle pattern, could be a moving average cross, or whatever. Institutional traders will buy at the level. Now, most traders will put their stop loss a tick under the last low, and they will invariably put their stop loss at exactly where the institutional orders are. I think that institutional traders are just doing what institutional traders do, putting their entry points at very good levels. However, if you are trading at the institutional level, it's not always easy to get filled. At the retail level, if you want to buy 100 shares, you want to buy the pound against the dollar at a 5 or a point, you press the little button and you've got it. At the institutional level, it's not that simple, and you've got, on occasions, to actually generate the liquidity to get aboard. I don't think that anybody looks at where the stops are, but they will say to themselves, well, we know pretty sure that most of the stops will all be crowded around this obvious level. So they will bid the market at that particular level. All you need is one person to chicken out, and the markets are going to go where the bids are, and all those people will be taken out. So I think that if you do not think long and hard about where you're going to put your stops, that you're going to find that you can quite easily die in a sea of stop losses. And here's an exercise for some people. The next time you're just about to put a trade on, you pick up something heavy and you just go, poof! And then you write down on a piece of paper where you were going to buy and where you're going to put your stop loss. Don't buy it, but put an order in to buy it at where you're going to put your stop loss, and then just watch how many times the market goes to your order. Okay, markets will go to the obvious stops most of the time, and one of my rules is that I want to put my entries where the masses put their stops.
What David Paul just explained is exactly why understanding inducement is so important. Because before the real move begins, the market often needs to create liquidity first. So traders, what is inducement really? Inducements are specific market setups designed to tempt traders into entering positions, often in the wrong direction, so smart money can collect liquidity. In simple terms, an inducement is a trap that leads traders to enter the market in the wrong direction before the real move begins. Because smart money needs liquidity, they often induce traders into early breakouts, fake reversals, or misleading pullbacks. Traders may see order blocks that look clean, but are not the real ones, FVG fills that appear to be valid entries, or equal highs and lows that look tradable. Then price suddenly reverses, sweeps their stops, and moves in the intended direction. Understanding inducement is important because it helps you avoid entering too early at fake levels or liquidity traps. Instead, you learn to wait for the real point of interest, which can significantly improve your win rate. To understand why inducement appears in the market, we first need to understand how liquidity works. Imagine that large financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To execute these large positions, they require a significant number of sellers and corresponding sell orders in the market. Without available sellers, no transactions can take place. Because of this, smart money often needs to trigger the stop-loss orders already present in the market in order to execute their buy or sell positions. This is why the market sometimes creates movements that make traders believe they clearly understand what price is doing. This situation can create an illusion for retail traders, making them believe they are trading on the correct side of the market. However, instead of continuing in that direction, price often moves toward their stop-loss levels. After triggering those stops, the market then resumes its intended direction. That is why identifying liquidity on the chart is essential for traders who want to understand how price truly moves. And this is exactly where the concept of inducement comes into play. At its core, inducement means creating liquidity before the real move. It is the final liquidity created to fuel the true move, and it can appear in different forms: structural inducement, liquidity-based inducement, and time-based inducement. Let's begin with structural inducement. Among all types, structural inducement is the most important because it appears directly inside market structure and forms patterns that traders see every day. Structural inducement occurs when price creates a false structure shift, such as a fake CHOCH or a misleading BOS, which encourages traders to enter early or in the wrong direction. In this example, price is trending higher and continues printing bullish breaks of structure to the upside. However, when we focus on the most recent break of structure, it initially appears completely valid. Price breaks and closes above the swing high. Naturally, this leads traders to expect buy setups at the demand zone or order block that cause that break. Then the outcome becomes clear. You enter the buy, and price quickly takes you out. This is exactly how structural inducement traps the majority of traders. The reason becomes clearer when we look deeper. This so-called BOS was never a real break in the first place. The entire move was driven by resting buy orders sitting below, inside the discount zone of the main bullish leg. If you draw your Fibonacci tool from the swing high down to the swing low, you will notice that price did not even retrace into the 38.2% level, let alone the 50% level of the previous impulse. This is critical. For us at Comlucro, a retracement that does not reach at least the 38.2% level cannot be considered a valid retracement. And even when price retraces only to the 38.2% level, these very shallow pullbacks tend to create inducement and liquidity hunts rather than clean entries. Because of that, traders must be cautious with shallow retracements. The ideal scenario in a bullish trend is to wait for price to retrace into the 50% level or deeper, where price enters the discount zone. This is where real institutional buying is more likely to occur, and where you avoid becoming liquidity for inducement moves. Understanding this helps you avoid fake structure breaks, recognize liquidity-driven pullbacks, and stay aligned with the real direction of the market. Now let's move on to the second type of inducement. Liquidity-based inducement is the most common form of inducement you will see in the market. It occurs when price intentionally creates a new high, a new low, or a small order block or breaker that looks very clean, with the purpose of attracting traders, collecting their liquidity, and then delivering the real move. And this happens every single day across all markets and time frames. The main objective behind this behavior is to generate stop losses that smart money can use as fuel. By pulling retail traders to the wrong side of the market, their stops can be collected right before the true move begins. That is why you often see a small high form before price drops, a small low form before price rallies, a fake breakout before a reversal, or equal highs and lows getting swept by just a few pips. These are not coincidences. This is smart money deliberately engineering liquidity. To understand this behavior even more clearly, we need to look at where liquidity actually sits on the chart. This brings us to the concept of static liquidity. Static liquidity refers to specific zones in the market where a large pool of orders is resting, such as stop losses, buy stops, and sell stops. When a trader gets stopped out of a position, the market absorbs the orders associated with that stop loss. Recognizing a liquidity sweep before price reaches our point of interest is therefore very important. These sweeps often confirm the strength of a supply or demand area, and many traders use them as a confirmation factor. The idea is simple. The market requires liquidity in order to generate momentum. If price does not sweep liquidity before reaching a key level, that level often becomes the liquidity needed to fuel the next move. Static liquidity can appear in several common areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and inside order blocks. It can also form around support and resistance levels, Fibonacci retracement levels, and near important candle bodies or wicks. Because these zones are widely recognized by traders, they tend to attract large numbers of stop losses and pending orders. For this reason, price often moves toward them to absorb liquidity before continuing its real move. Now you might wonder why price often forms an inducement right before tapping into a fair value gap. The reason is simple. If price moves directly into an FVG without inducement first, there is no liquidity. Smart money has no fuel to reverse the market. The reaction from the FVG becomes weak, and the entire setup can fail due to a lack of sellers to buy from. In simple terms, inducement is what creates the liquidity that fuels the move out of the fair value gap. Now that we understand the logic behind inducement and liquidity, let's move into real chart examples and see how these traps actually form inside market structure. We will start with one of the most misunderstood and exploited inducement zones in trading, the order block. As explained earlier in the video, inducement often forms around areas where traders expect strong reactions from price. And one of the clearest examples of this behavior happens inside order blocks and supply and demand zones. As you can see here, price breaks the recent market structure to the upside and generates this bullish order block, where traders look to take long positions by setting their buy orders, believing this is a strong continuation area. But as you can see, price does not respect this bullish order block. The setup fails, liquidity gets collected, and the market reverses. In this case, the order block becomes an inducement zone rather than a valid continuation setup. Again, we have another order block a little bit lower, and once again, price does not respect the level. This is another example of inducement forming around a highly visible order block. Later in the video, I will show you how to distinguish high probability order blocks from inducement zones, so you can avoid weak setups and focus on areas where real institutional activity is more likely to be present. Now, the next zones where inducement often occurs are support and resistance levels. As you know, support and resistance are some of the most watched levels in trading. Because of that, they naturally attract large amounts of liquidity and stop losses. For example, we have this major support zone that price has already reacted from multiple times. Naturally, many traders expect the market to respect this level again and continue moving upward. So traders begin entering buy positions around the support zone. But as you can see, before moving higher, price first pushes downward and sweeps the stop losses resting beneath the support area with this long wick. Only after collecting that liquidity does the market rapidly reverse to the upside. So traders, this is another clear example of inducement inside market structure. Another common inducement area is swing highs and swing lows. As explained earlier in the video, liquidity tends to accumulate around obvious highs and lows because traders frequently place stop losses and breakout entries around these areas. For example, on the New Zealand dollar versus United States dollar daily time frame, we have this swing high as the highest point price recently reached, and this swing low as the lowest point. Most traders expect price to respect these levels and reverse from them. But as you can see, price creates fake breakouts around these areas and sweeps the liquidity resting beyond the highs and lows before delivering the real move. So, traders, we can also consider these areas inducement zones. Trend lines are another common area where inducement frequently appears. For example, we have this trend line that price touched twice. Many traders would look to take a short position after price respects the trend line on the third touch. If price breaks above the trend line, they may look for long positions, believing the breakout confirms the move. This behavior repeats itself constantly in the market. Traders recognize patterns, place orders based on their analysis, and often enter positions exactly where liquidity is building. So, traders, how can we use inducement to our advantage? Here we have a schematic figure that simulates price movements. As you can see, we have a downtrend. Price mitigates this zone here and then reverses to the downside. The price pushes downward but could not break the recent structure. Then price makes a small pullback to the upside. After gaining enough momentum, price pushes downward again and creates this break of structure here. So, traders, we now have this unmitigated zone here where price may potentially reverse. We also have another unmitigated zone right here, created by the recent break of structure. In situations like this, many traders become uncertain about which zone is actually safer to trade. As explained earlier in the video, inducement often forms around setups that appear highly attractive before the real move begins. For us, this zone becomes an inducement level because, as you can see here, price attempts to mitigate the upper zone. But before reaching it, the market rapidly pushes downward and breaks the recent structure to the downside. In scenarios like this, many traders enter sell positions when price begins mitigating the inducement zone. As price touches the level, the slight rejection makes traders believe the move is already starting. That reaction attracts even more sellers into the market, with many stop losses resting above this double top. Now, as you can see, this behavior creates massive liquidity right below our first unmitigated zone. As expected, price moves toward the liquidity, resting below the structure. Price then returns to the first unmitigated zone, sweeps the liquidity, and continues moving in its primary direction to the downside. This is a simplified example showing how inducement and liquidity interact inside market structure. For a better understanding of this behavior, let's move into another schematic example. Here, we have another downtrend. Price creates this low. After the pullback, price pushes downward again and generates this break of structure. We can easily identify this unmitigated zone here. We also have this double top, which creates a strong liquidity zone resting above the equal highs. Naturally, we expect price to eventually sweep that liquidity before mitigating the order block. The double top also acts as a resistance level, leading many traders to enter short positions expecting continuation to the downside. Normally, traders expect price to sweep the liquidity resting above equal highs before moving lower. However, in this case, price continues downward immediately after mitigating the zone. In situations like this, many traders become confused and ask why price moved lower without first sweeping the liquidity resting above the equal highs. The important thing to understand is that we do not always know exactly when the market will return to sweep resting liquidity. It could happen in an hour, a day, or even much later. But in many cases, price eventually returns to those liquidity pools. Because of that, traders should remain cautious when liquidity is clearly resting above or below the current structure. Let's continue. As you can see, after reaching this zone, price pushed downward and generated this break of structure. For us, this unmitigated order block created by the last break of structure becomes an inducement level. At first glance, this looks like a very attractive sell zone for traders following smart money concepts. The level is created from a break of structure, and the move downward also leaves imbalances that make the setup appear even stronger. However, many traders focus only on the order block itself and ignore the liquidity resting above the zone and around the unmitigated level above. We also have this trend line that, when touched by price, encourages many traders to enter sell positions. As a result, liquidity begins building above the structure. So, traders, this setup appears highly attractive for short positions. But as we explained earlier in the video, inducement often forms exactly where the majority of traders feel the most confident. Because of that, we consider this zone an inducement level and avoid entering the market here. As you can see, after initially reacting from the inducement zone, price suddenly pushes upward, mitigates the higher zone, and sweeps the liquidity that had been building for a long time. It also sweeps the stop losses of traders who entered sell positions from the inducement level. Only afterward does price continue lower. Let's look at another common market scenario. On the left side, you can see price in a downtrend respecting this channel multiple times. After making this lower low and mitigating this important bullish order block, price changes direction upward and moves toward the top of the channel. We can consider this area an inducement zone. Many traders who follow chart patterns begin entering sell positions as price touches the top of the channel, placing stop losses above the structure and creating a liquidity pool in the process. This creates the liquidity needed for the next expansion. In this scenario, price suddenly pushes upward, breaks both the structure and the channel, sweeps the stop losses of sellers, and gains additional momentum through the breakout. At the same time, many breakout traders aggressively enter long positions, believing the breakout confirms continuation to the upside. This creates liquidity from both sides of the market. Then, after this pullback, traders continue entering buy positions, expecting price to move even higher. Price continues upward and forms this temporary trend line. But then, price suddenly drops and sweeps the liquidity resting beneath the temporary uptrend, triggering the stop losses of traders who entered buy positions too late into the move. After collecting liquidity from both buyers and sellers and mitigating this X-demand zone, price pushes upward again. Here, we have the euro versus the United States dollar on the 1-hour time frame. As you can see, price changes direction to the downside after creating this change of character. Then, we have a break of structure, where price closes below the recent lower low. Shortly after, another break of structure forms. So, traders, at this point, the market appears bearish. Next, we have these equal highs, showing liquidity resting above them. We also have this unmitigated order block generated by a break of structure. Naturally, many traders expect price to return to this zone, sweep the liquidity above the equal highs, and then continue lower after mitigating the order block. But as you can see, price goes up, reacts from the zone, and reverses downward. Traders who entered short positions from this level were ignoring the liquidity resting above the equal highs, even though price initially reacted from the order block. As expected, price eventually continued moving toward the liquidity resting above the structure. So, in this case, traders focusing only on the order block ignored the liquidity pool resting above the structure. Many traders then looked for another short entry from this order block, generated by the recent break of structure, because the setup appeared highly attractive. First, it is an unmitigated order block. Second, price had already reacted from this area previously. As a result, many traders focus only on the setup itself while ignoring the liquidity resting above the highs. But as you can see, price eventually pushes upward, sweeps the trendline liquidity, takes the stop losses resting above the inducement level, and finally reaches the higher unmitigated order block. After sweeping the liquidity resting above the equal highs, price rapidly reverses to the downside. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the Lucro Trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the Lucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.